Hello everyone. It has been just over 6 months since we produced the first video on CPF at age 55. I have primarily been doing these videos in order to share with my cohort, my batchmates, my schoolmates, how I am making decisions about my retirement funds. So I'll give a quick rundown, recap what we have already discussed earlier. And then now that I have already crossed my 55th birthday, I have decided how I'm going to allocate my funds. And so I'll share with you how that is done. Disclaimer, in no way am I making any product recommendations. I'm also not trying to give you advice on what to buy. I'm sharing my journey and my decision process. So I'm sharing my thought process and the logic as to how I derive a solution that is fit for me and my family. The world has changed since I started work in 1994. My preferred path for managing my retirement funds, and then at the end of it, what I'm going to do with my life in the next 20 years if I get to live that long. Quick recap, which if you need the more details on this part of the video, you can always go back to the playlist on YouTube and recap and watch what I have produced in December 2024. Now, the minimum sum since I started my first job versus the full retirement sum in 2025 has gone up by quite a significant amount over these last about 30 years. The retirement age, as we've worked, has also gone up by a lot. And you know that the statutory retirement age, once it gets pushed, which accounts for our longevity as well, and accounts for our perhaps our ability to contribute to the labor force for a longer period. That also means that CPF payout eligibility age has also in the last 30 years been moving up and up. And now that we are going to be seeing increase in the retirement age from the workforce, there is even more room for this CPF payout eligibility age to be pushed back, to be in line with the pushing out of our retirement age. Now, life expectancy at birth for Singaporeans and PRs here has also been increasing. Of course, in the last 3 years, we have seen a little bit of a drop due to the additional deaths caused by the COVID virus and perhaps complications from some other causes around the COVID-19 period. But you see, when I started work, Singaporeans were expected to live to about 76 years old. Now we are at 83. We were at the 84 age. Now we are at 83. Looking forward, looking at this graph on the aging demographics, you see that the baby boomers, who are probably the earliest ones to start contributing substantially into CPF from their employment, the baby boomers will be, in the next 20 years, be passing on in relatively large numbers. And because of that, with a very low birth rate, you see that the cohorts of the Gen Z and the teenagers cohort these days are getting smaller. So you might see that there's going to be a little bit more of a full CPF redemption as baby boomers start passing away in larger and larger numbers in the next 20 years or so, versus the contribution by the younger generation who gets into the workforce and then start contributing month by month. So from CPF as a fund manager from CPF's point of view, it would be a case of having to balance the outflows from all the big CPF withdrawals due to the passing away of the CPF member versus balancing the the drips and drabs of the Gen Z and as well as the current cohort of teenagers who are getting into the workforce in the next 10 to 20 years, and their contributions coming in smaller amounts. So there's going to be some form of fund balancing work to do for CPF in the next 20 years. I hope they are starting to consider that now. So one of the ways for CPF to balance off this would, of course, to delay all the CPF withdrawals, or to cap withdrawals, or perhaps to have some scheme which would encourage people to lock up their CPF funds for longer. And of course, the other trend that is just in the more recent years is we do see this little bit of excess deaths. The pre-COVID 2017 to 2020, you see the bottom half of the graph, the monthly deaths in Singapore. And then after COVID has happened, and when we were all getting our shots and our boosters, you see, I mean, it could be coincidental. It could be just that in the year 2021, our demographics reached a stage where there's suddenly this lifting up of the number of deaths. But, well, we can't say that this is actually totally coincidentally not related to COVID-19 or whatever measures that came along post COVID-19. It could be mental, it could be due to changes of lifestyle, it could be due to cost of living issues that also then leads to maybe poorer health, especially mental health. And of course, then there is the massive different types of vaccinations that we all went through. Now, so with all these data, how did I then consider what I wanted to do with my CPF money? So I've already said that my decision is to just leave the FRS, the full retirement sum, which is now at 213,000 in my retirement account. Anything in excess of that, I'm going to be withdrawing to manage by myself. So in selecting how I want to manage my own cash, it is good for all of us to remember this magic triangle or trifecta or trilemma, however we want to call it. Basically, in fund management or financial management terms, we could choose 2 out of the 3. It is almost impossible to have a fund or a pot of investment where you can have liquidity, meaning at any time there's a flexibility for you to withdraw, take it out and spend it on your next holiday, as well as to have yield, as well as to minimize risk. So if you want to have low risk and you want to have high liquidity, you have to sacrifice yield. If you want to have one, you and the other, you have to sacrifice the third. That's what this magic triangle means. So for me, I treasure liquidity. And because I'm planning for my own retirement adequacy, I want to have low risk. So in order to have liquidity as well as low risk, I have to somehow sacrifice a little bit of yield. Most people who have commented in the earlier videos have been asking, why not just leave it in CPF, leave it to the maximum enhanced retirement sum, ERS. But based on my previous charts about how CPF may be delaying withdrawals, and also the stories of how some people who need emergency funds due to a medical event in the later parts of their life, that even though their CPF money is earning higher yields, but they are unable to have the liquidity and the flexibility of withdrawing the CPF. So you just cover up one part of the triangle, and then you choose the other 2, and you know what you have to give up. So at this stage, of course, I would not also be going for high yield because high yield also would usually come with higher risk. Now, there are also financial planners who have proposed packages, investment packages or insurance-linked investment programs that have got 5%, 6% yields that even beat the CPF retirement account. But those always come with the caveat of, oh, these are merely estimates. This assumes that you are placing them into a certain pot of funds where during great stock market or during technology boom times, these funds perform exceedingly well. But then it also comes with the market volatility and risk, which is not really suitable for somebody who is planning for the last decade of his life or so. So just to borrow a couple of slides from my university lessons, liquidity is the degree to which an asset or security or an investment could be divested and then without affecting the asset's value and then converted into cash. How easy is it? How quick you can do it? So most liquid, of course, is to hold everything in cash in my savings account. Outside of CPF, I can use it anytime I like. And then there's stocks and bonds, which may take 1 day, 2 days to settle before the cash comes back into my account. And then there'll be other investments such as precious metals, real estate. And then there's the investments of passion such as art, wines, whiskey, and antiques. Those take a longer time to liquidate, excuse the pun, and they also incur higher costs when you are divesting them and converting them into liquid cash for you to deploy elsewhere. Now, there's of course a cost to having a product that is very liquid versus a product that is stuck, which is more difficult to transact. So there's in finance terms, again, there's this concept called liquidity premium. And these three fund managers from the very respectable investment house called PIMCO, they have put up a recent paper analyzing what is this liquidity premium, how much exactly does it cost? And in short, their answer is if you have an investment that is stuck in, say, real estate or invested into a fund with a lockup period, and you should expect that fund to produce you a return that is 2% higher than a fund that is invested in very liquid investments such as a bond fund or equities fund where you can quickly sell off to convert that into cash. So just to repeat, an investment that is put into some assets that are not so liquid, meaning it takes time to sell out, it takes higher cost to sell to be converted back into cash for the investor to use, should produce an annual return that is 2% more than an investment that is in a liquid form, such as in equity funds or in bond funds that can be easily converted back into cash within 1 or 2 days. So I'm comparing this liquidity versus illiquidity against CPF retirement accounts. The CPF retirement account is not something that you can just liquidate and take out your 200,000 immediately to use. They have locked you up, and then subsequently, post 65 years old, they are paying out monthly, and there's no way you can take out that whole chunk of 300 over 1,000, including accrued interest, to be used straight away. So that is a locked out illiquid fund, and they are paying 4%. So versus me taking out the money to be invested in something liquid, such as the money markets fund or the government bond funds, for example, I can have a liquidity discount of 2% from the 4% that the retirement account will pay me. So, meaning if CPF retirement account is estimated to be paying 4% throughout the next 30 years, as long as I can manage my own cash at more than 2% returns, 2.5, 2.3%, then I'm already eating the CPF RA returns, which is totally locked up and not flexible for withdrawal until death. So that's the concept that I'm going along with. So the scenario that I've planned and given to Simon, my financial advisor friend, is that I will withdraw about $200,000. I'm not going to try to beat CPF RA and CPF life returns. The priority heading into retirement is capital protection, so low risk. I'm happy with slower, steady, and lower returns at about 2%. And I want to have the flexibility to withdraw the cash for emergencies in case I get a stroke of, excuse the pun, stroke or a tumor, a stroke of bad luck. And this also helps me take into consideration the financial needs of my parents, my spouse, my siblings, my children. So, cut a long story short, we've gone through quite a lot of different packages to select the product. I finally made the decision to go with this product from FWD Insurance. It is called the Life Income Plus, and the illustration is given here as Bob at age 30 buying into this Life Income Plus plan with an annual payment of 30,000 for 5 years. So Bob invested 150,000 over these 5 years. Now, the illustration then shows that at the end of the 5th year, meaning from month number 61, he can start to withdraw from this fund, and it will be good for him, in fact, to withdraw all the way until he's 120 years old. But in this illustration, it shows that he then surrendered the fund because he needed money when he's at age 75, and Bob then received 381,000 in of cash along these years, plus the surrender value, which is capital protected, which is the 150,000 that he paid for. So in all, he took back 381,000, but his initial investment was 150,000. This plan is flexible for me after the 5th year to withdraw the 150,000 that I would need in case of emergencies. Many people also ask, why not self-manage the cash? Yes, I am self-managing the cash, but this is one portion that I'll allocate to a fund manager, in this case, the insurance company called FWD, to help me manage. I am looking to do private equity investments myself, doing urban regeneration in Japan by investing in some of these old houses. And I also want to invest in my own health, especially mental health. So I'm going to continue working on my real estate business, do probably more teaching, research, consultancy, write my next 2 or 3 books before I'm gone. I will manage my funds as I've explained in the past slides. And then I want to live a slower pace of life doing urban regeneration work. A final parting shot until our next videos. A large number of Singaporeans planning their retirement realize that they are asset rich, cash poor. But you have got to realize that you have come to this stage at your age 58, 63, realizing that you're asset rich and cash poor because of decisions that you have made 30 years ago. At the point of entry into the labor force, as well as at the point of making significant life decisions such as the BTO, taking on your home loans, making your career switches. So we have to keep this retirement adequacy plan in mind from when we are about 30 years old. I wouldn't say start at 25 or start at 20 when we got out of school, but we have got to continually be thinking about this as our life and our family situations evolve and change. Thank you for staying with me during these few videos. If you have got any questions, please ping us, ping me, ping my colleague Justin Chong, who has been helping me with putting together all these videos. Thank you very much. Have a happy retirement.